The more I put out content here on YouTube and on my podcast, and I've been doing this for a very long time now, the more I am amazed at the lack of knowledge about some very basic stuff. Now, I'm amazed, but I'm not surprised. The whole reason I began this project back in 2009 was to try and do my bit to fill the knowledge gap. But the more people who know the basics of investing and all that stuff, the better off we'll be as a nation and as a planet. It's all good stuff. And today I want to show you everything you need to know to start investing. It's not difficult, it isn't complicated. Let me show you. Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based in the UK. I've been putting out videos on YouTube for more than 10 years, giving you everything you need to know and everything you need to do to secure your financial future. Investing is simply the process of exchanging money in your bank account, which is really only useful for spending, exchanging it for different kinds of assets, which are going to grow over time. That's all it is. Now, assets, they grow in one of two ways. They can produce an income, which you can then use to buy more of the stuff that you're investing in, or they can grow because the market thinks they are worth more now than they were worth yesterday, or a year ago, or 10 years ago. The best investments offer both capital growth and income. Let me give you the short version here right at the top, and then I'll go into a little bit more detail. The assets that have grown the most consistently over the past few decades are shares, otherwise known as equities, and property. Shares and property, or what my good buddy Andy Hart of MeaningfulMoney calls businesses and bricks. Now, property is an investment that most of us understand to some degree, but it's hard to get into. It requires you to have a pretty big amount to invest up front. It carries quite a lot of cost, and it's not very tax efficient these days. There is definitely still a place for property, but I'm not going to cover that today. The best place that I know to learn about property investment is the Property Hub. There's a link in the description to that. And so we're left with equities, businesses, shares, and we need to find a way to invest in them simply, cheaply and efficiently. Now, just quickly a disclaimer here, I'm not going to be mentioning specific investment providers in this video. To do that would cross the line into advice, and I just can't do that. You have to remember, investments go down as well as up, and you might lose your investment if things go wrong. Your capital is at risk, so tread carefully. Before we go any further, if this video is helpful at all in cutting through the noise of investment advice online, please hit the like button and subscribe to the channel. Really helps more people to see the videos and learn this essential information. So to invest in shares cheaply and effectively, we need to talk about index tracking, because I think it makes the most sense for any investor, both beginners and more experienced folks. Now, I'll do another video that'll go into some depth about why I think that, but for now, let me just say this. An index is a collection of shares, usually grouped by location and sometimes by size. So the FTSE 100 you may have heard of, that's an index, and it's a UK index, and is a collection of the 100 biggest companies registered in the UK. Now, an index is just a measure of the combined value of those companies at any given time. If the value of the shares in those companies, all added together, increases on any given day, the index will rise also. If they fall, then the index will fall also. Shares fall and rise mostly because of investor sentiment. It isn't always rational for that reason, but if you're going to invest at all, you need to understand that your money is going to go up and down. Now, you could try and choose which shares you think are going to rise, but you'll probably get it wrong. I know that I would. In fact, the evidence shows that even professional fund managers whose job it is to try and pick the winners, they get it wrong more often than they get it right. That whole process is called active investing. Now, an index tracker is a fund that you can buy which invests in the shares of a given index, and it aims to track the market or the index as a whole rather than trying to pick the winners. And this is called passive investing or index tracking. And I think this is the best way for anybody to invest the bulk of their money. And it's definitely the best way for a beginner to get started. So how do you find an index tracker fund? Well, the easiest way is to use your platform's tools to help you. And if you don't have a platform yet, all they are simply websites that provide investment accounts. So you just have to sign up for one, open an ISA or whatever, and then add some money to your pot. Then you have to tell the platform how you would like to invest your money. So I'm going to show you now how to use one such platform. In this case, it's the biggest one in the UK called Hargreaves Lansdown. Others are available. I'm going to show you how to find a tracker fund. It takes less than 30 seconds to do.
30 seconds? Maybe, maybe not. This is the Hargreaves Lansdown homepage, and if we hover over funds here, you can see we can search over 3,000 funds. They do have some short lists. I usually suggest you avoid these, but I'm going to show you how to avoid them. If we click on the fund finder here, you can see 3,774 funds are available on the Hargreaves Lansdown website. So we clearly need to filter that down. Remember, we've been talking about tracker funds, so we can just choose those, and we're immediately down to 195 funds. If you have the option to choose the unit type, if you're building wealth, you want accumulation funds. It doesn't matter why for now, you just do. That takes us down to 111. And then finally, in a sector filter, every platform offers this. You can see we've got areas of the world and also different kinds of investment, different asset classes. I'm going to suggest you choose a global sector. And you can see 111 funds is now down to 16 from 3,700 at the start. And we got a bunch of options here. I'm not going to suggest which might be good for you because I'm on a bit of a sticky wicket if I do that. But you can see we've whittled down 3,500 funds right down to 16 possible options, which is a lot more manageable.
Now, if you invest all your money in shares, you're in for a rocky, difficult ride. Author J.L. Collins, author of this book called The Simple Path to Wealth, he describes the journey as sometimes leaving investors bleeding by the side of the road. Truly harrowing stuff. This volatility can be tempered somewhat by following just a couple of basic rules. Firstly, spread your money around, eggs in baskets. By investing in a global index tracker fund, you will hold under the bonnet tens of thousands of shares spread all around the world. So if any one of those companies goes bust and their shares become worthless, you won't even notice. Now, if all of those tens of thousands of companies goes bust, yes, you will lose everything. But to be honest, if that happens, we've probably got worse things to think about than money problems. Another way to temper the volatility of your investments is to balance out the shares with another kind of asset called a bond. Now, these are essentially IOUs. They are loans to governments and companies. And there are indexes for these too. So you can buy a global bond index tracker just as easily as you can buy a global equity index tracker. Even easier, you can get all of this done for you by buying a multi-asset fund. And this is how I suggest anybody who's getting started investing should begin. These funds come in different flavors where you can choose different levels of equities. Anything from 20% equity all the way up to 100% in shares. Remember, as a general rule, more shares means more volatility, deeper ups and downs on your journey. So if you're brand new to investing, a good place to start would be a balanced multi-asset fund, roughly a 50-50 split between equities and bonds and other stuff. So let me show you quickly how to find those funds.
Okay, finding multi-asset funds is simply down to choosing a different sector. So I've already selected tracker funds here, and I've also already selected accumulation funds. So we're at 111. The sectors where you'll find multi-asset funds, there's 5 of them. Flexible investment. Then we've got 3 mixed investment sectors, and you can see they're named after the percentage of shares that the funds in those sectors will hold. So if we just select them all for now, and then right down at the bottom, we've got the volatility managed sector. You'll see that now we're down to 8 funds. Now that might actually be too few to choose from. If I was to deselect the tracker option, it does actually bring quite a lot of other ones in. But to be honest, that selection will probably do you okay.
I hope this is useful so far. It's really not easy trying to distill all this down to just what you need to know here. And I know it's going to raise further questions. If it does, then the best place to take this further and learn more quickly is Meaningful Academy Build Wealth. And this is a course that I've created for anybody who's looking to build wealth for the future, understand investing, gain a good mindset and plan effectively. Best of all, there's a year's access included to the world's best financial planning software app called Voyant Go. I use it every day with my clients, and I'll teach you how to use it to plan your own financial future. So you can learn everything about that at meaningfulacademy.com/buildwealth. If you decide to sign up, use the coupon code YouTube and you'll get a deep discount on the cost. Okay, so we've talked about multi-asset funds as the basis for any investment portfolio, and we've looked at how to find them. If you want to take things a step further, you could keep these funds as the main part of your portfolio and then add other investments around the side. So you could buy some actively managed funds around the side as opposed to the passive ones where managers are actually choosing the shares for you rather than just tracking markets. You could stick to multi-asset stuff for the most part, but buy some sector-specific funds around the side, like a technology fund or a China fund or whatever you fancy. Don't bet the farm on these sideshows. I call this a core and satellite approach. Your core should be passive multi-asset, in my view. Anything around the side can be whatever you want. I've got crypto in my satellite holdings, for example. Keep your satellite holdings to less than 20% of the whole of your portfolio, and you should be fine. Now, as you can imagine, there is a ton of detail that we could go into here, and in Meaningful Academy, I do just that. But there's also tons of free videos here on this channel, hundreds of podcast episodes where I go into a load more detail, and they won't cost you a penny. In a future video, as I've said, I'll go into the whole passive versus active investing thing a bit more, so watch this space for that. And finally, thanks for watching. I hope you found it useful. There is a community of like-minded people in our Facebook group. There's a link in the description below to that. Don't forget to smash the like button and subscribe to the channel if you're not already. Thank you so much. I'll see you in the next video. We covered a lot of ground today.